Welcome to the TrestleBridge Capital monthly video series entitled Asking for a Friend. I'm your host, Eric Jefferson, managing partner with TrestleBridge. And for this month's installment, we're going to focus on how higher interest rates slow an economy. Specifically, offer some detail into these specifics. That's something I know at times our industry and certainly myself is guilty of moving too quickly or high level. And having received a few client questions based on everything currently taking place with rates at the Federal Reserve was something I wanted to take a few moments to just go into a little more detail. Now, before we get started, I have a few quick words from our legal team. With that, we can go ahead and begin and want to do so by just re-emphasizing or offering some context with respect to our economy. GDP, or gross domestic product, is the most widely accepted measure of an economy. At the end of the day, that is the sum or total monetary value of all finished goods and services sold within a country within a particular time period. And the end of the day, that is a function of the number of transactions that took place and the price of those underlying transactions. Now, when we think about the impact of higher rates, before we get into the specifics, I want to just reinforce the two roles here. If you are a borrower, so let's say an individual applying for a mortgage or a loan, as interest rates go up, your costs go up. Vice versa, if you are a lender, let's say you're a checking account holder, you are in essence depositing money into a checking account, you are lending that institution your capital. Typically, as interest rates go up, at times and often following a delay, the amount of yield or income you receive will move up accordingly. Now, when we think about the impact of higher rates on an economy, there's three key areas that apply both the borrowers and the lenders that ultimately reduce the number of transactions and or the cost associated with the average transaction. Now, the first, from a borrowing standpoint, if rates go up, all of a sudden, you no longer have the ability to borrow similar levels of capital on a same fixed monthly payment. The best way to illustrate this would be the example of a mortgage. On the left-hand side of the page here, I have an example where a prospective home buyer able to afford $2,100 a month towards their mortgage. If they apply for a 30-year fixed when rates are at 3%, they're able to be loaned $500,000 they can combine with a down payment for their first home purchase. However, if rates were to double on a 30-year fix at now 6%, that same monthly payment of $2,100 only going to provide a loan amount of $351,000. So you think about the average home that's now purchased throughout the course of a year. If rates are up, prices are down based upon a now limited borrowing capacity. Obviously, at the end of the day, lower a price sale goes for, smaller commissions, less taxes paid, so on and so forth, ultimately having a downward impact on the economy. The second piece I want to focus on here is from the perspective of the lender. So let's say you're a business or an institution that has a surplus of $200,000 and you're faced with the decision how to allocate that capital. Option A, you can invest in a new business or venture, open up a new plant. You've done some research and you're fairly certain a $200,000 allocation would create you positive cash flow of $50,000 each year, every year for the next 5 years. Now, in that scenario, at the end of that 5-year period, $200,000 cash outlay, you received $250,000 of cash flow in. That ultimately would translate to a profit of $50,000 or 25% of your initial investment. Now, let's say you compared that with simply putting that additional or surplus $200,000 into a checking account, making 3%. If you compounded that 3% growth year over year for a 5-year period, the end of year 5, you'd have a total value $231,000 and change, a profit of $31,000, which translates to a return nearly 16%. Of those two scenarios, you can see where investing in the new business, going out, hiring new workers, hiring contractors to build the facilities, that ultimately creates a better return, all else being equal with respect to risk and tax. Now, fast forward though, let's say interest rates in a checking account were all of a sudden 6%. You're faced with that same decision: invest 200K to earn a profit of 50,000, or invest at 6% annually. If you went option B, now all of a sudden at the end of year 5, you have a profit of $80,000, represents a 40% return. Of those two, all of a sudden, option B starts to look a lot more attractive. And the end of the day, if you're now taking money, investing that, or simply parking that in a checking account as opposed to investing or providing loans for businesses to grow, that obviously will decrease the number of transactions that take place, putting downward pressure on the overall economy. Finally, want to focus on the consumer. So this applies to both lenders and borrowers. And it is in a higher interest rate environment that typically will wreak havoc on investments. Calendar year 2022 is the perfect example. We saw a significant increase in interest rates, combating obviously record levels of inflation. That weighed very heavily. We saw the S&P illustrated in the blue there, down over 18%. You also saw treasury bonds. These are considered risk-free with respect to default. Those were down double digits. Longer duration government bonds, those that matured decades down the road, down nearly 30%. These were the bonds that got Silicon Valley Bank in trouble. They had a great deal of duration or sensitivity to changes in interest rates. And as a result, again, historic rate rise weighed very, very heavily on consumers. That has sparked a handful of recessionary concerns as well. You've seen asset values come under a great deal of pressure. And in that environment, whether you're a company that's thinking about deploying surplus capital or simply hanging on to that to have some dry powder, vice versa, if you're considering is now the time, possibly going into a recession to take on the risk of starting a new business, overall sentiment may likely weigh on you, thus reducing the amount of new initiatives, growth, dollars ultimately spent, as opposed to what may transpire in a regular year. That's all for today. As always, hope that was helpful. Happy to discuss anything in more detail, and strongly encourage you, please send any additional questions directly to myself for consideration going forward. Thanks again for your time. Have a great rest of the day.